Welcome to Alternative Investments Chat,
where we demystify the world of alternative investments and financing for entrepreneurs and investors alike.
With these discussions, we hope you're more empowered to unlock opportunities in your business or portfolio. I'm Erin.
And I'm Erica. Let's get started. Hello, and welcome back to another episode of Alternative Investments Chat. So today we are continuing our journey in equities. It's been a very long journey. I'm tired of traveling. No, I'm just kidding. These equities I love looking at all these. But the equities that we're talking about today, speaking of traveling, they have their passports.
Fancy.
That's right. We're taking this baby international, right? So what if I told you that the biggest investment opportunity in this decade isn't in the U.S. at all? But actually it comes across oceans, currencies, and entire economics. Most investors are economies, I guess, that investors never even think about touching.
That's right. For more than a decade, U.S. stocks have dominated global markets, but recent data shows momentum beginning to shift away from that. And that raises one big question. Are international equities about to matter again? Come back into vogue, as it will. Today, we are breaking down international equities, what they are, why they matter, the risks that you need to understand, and what 2026 can hold for investors that are willing to look beyond domestic borders, because understanding global markets isn't just smart investing, it's essential diversification.
Gosh, you're so right there. We love that word, diversification. So what are international equities? International equities are simply stocks issued by companies located outside that investor's home country. So for obviously U.S. investors, that means non-U.S. companies.
Yep.
So, and then these are actually broken into two main flavors, as I like to call them. So we've got developed markets. So again, think Japan, the UK, much of, Western Europe, Canada, my favorite, Australia, the more established economies.
Yep.
And then we have those emerging markets, India, Brazil, Mexico, parts of Southeast Asia. Typically faster growth potential, but with a few little hiccups here and there, right? So if the U.S. stocks are like ordering from your usual spot, international equities is like opening up that delivery app, which I do a lot, and realizing that there are 2,000 different restaurants that you've never, ever tried.
Yeah, and it's time to try them.
Yeah.
Expand on your palate.
Exactly.
Your taste buds, well, I actually mean your portfolio, gets more options. In our last episode, we were talking about alternatives. Basically your portfolio being a buffet.
Yes.
So we're digging into some tikka masala. We're gonna have some
Just
sushi.
had that last week. I love that. Yeah.
We're gonna have just like a world tour here.
A little smorgasbord.
Exactly. Different industries, currencies, policy environments, and customer trends all encompass expanding outside of your comfort zone, which might just be the U.S. at this point. A huge share of the world's public companies live outside of the U.S. These investments can be accessed through mutual funds, ETFs, like broad international index funds, or direct ownership of foreign shares and depository receipts. The short version of this is to say that diversification is a must. We always share that on the show, and that's no different when it comes to this type of investing. Your portfolio shouldn't be a one country reality show.
That's right. And we know countries rotate leadership. Sometimes the U.S. is the main character, and sometimes we decide to take a little nap and let someone else shine. Let another country be the leader and still the scene. But diversification helps because markets don't always move in lockstep. They are often different inflation paths, different interest rates, decisions, different everything pretty much, right? So some markets have more banks and industrial, while others are tech giants, as we see here in the United States. On top of that, we have that currency exposure. If the dollar weakens, foreign holders can get a translation boost when you convert back to the dollar. And if that dollar strengthens, well, you might sting a little bit.
Yeah. Basically, currency is like a seasoning. A little bit of it makes it interesting, fun, exciting.
I like it.
But when you add too much, you might be reaching for a glass of water. I'm talking about certain people.
Yeah.
And I think I'll let you draw your own conclusions. Now, I think it might be time for a little bit of context.
Yeah.
For a big chunk of the 2010s and the early 2020s, U.S. equities dramatically outperformed international markets. And this was driven by mega cap tech growth, strong economic expansion, and the rising dollar. But everything that goes up must come down,
For the most
right?
part, yes.
That's what
Once it
they
gets
say.
stuck.
Someone said that.
Mhm.
For example, Fidelity Investments noted that non-U.S. stocks had an exceptional run in 2025, around 30% in that commentary, which outpaced U.S. by a meaningful margin at the time.
And you can see similarly strong recent year performances in broad non-US vehicles tied to the global EX-US indexes. So those EX-US indexes is where you would go to find those non-US companies,
Yeah.
their stock exchange, right? So basically what we're trying to say is that international equities, they're not bad in any shape, way, or form. They're just fashionably late to the party, per the usual. Like a good friend. Speaking of fashion, no, you're actually, depends. You're normally right within. We do have one girlfriend who is always fashionably late
Always
to
late.
our party, but she always looks great. So we
Yeah.
forgive her. So in fact, some forecasts now expected higher long-term returns from non-US equity compared to with recent history, especially across Europe and those emerging markets. We love those markets. At least I love those markets. With that, let's go into our favorite part of the episode, where we talk pros and cons. My
Pros and
favorite.
cons. Love it. Let's get the party started.
I love it.
So number one, our favorite word, again, diversification. The biggest advantage is diversification, reducing your exposure to any single country's economy or policy environment. That can, if you expand beyond just one, it can reduce the impact of market downturns and potentially enhance long-term returns for you.
Yeah.
So if one country is experiencing some issues and your investments over there are not doing so well, you got some other ones that might be performing better to kind of keep
Exactly.
you afloat. Pro number two, valuation opportunities. Some research shops have argued U.S. equity long-term returns may be more muted from here on, partially because valuations got stretched, while opportunities might look better in pockets outside of the U.S. You also have to think, too, other places are growing. And that kind of brings us to pro number three. You get access to global growth engines. This can lead to higher returns.
We like those.
In emerging markets, there's a place to grow and continue to develop. And those in particular can benefit from demographics, urbanization, and productivity. And pro number four, you're not betting your whole future on just one country's policy decisions or what's going on there. Some central banks choose chaos. Some politics choose chaos. Some energy prices choose chaos. Chaos always chooses chaos.
I know.
Chaos follows chaos.
I sometimes thrive in chaos. I'm one of those weird people who, like, sometimes when things are going so, the office is on fire and I'm sitting there and I really am fine because, like, I can kind of tune it all out. But that's not the case for these, right? Now it's time for those cons.
Yeah.
I
knew they were coming.
We've been switching it up lately, and so I've been doing the pros and making you do the cons lately. So I'll go back to doing the cons because, again, optimism without realism is simply a motivational poster. And every single time I think of a motivational poster, I think of the "you can do it."
Yeah.
I know that's like Waterboy from our movie podcast that we also host. Not really, but it's on the list. It's like, you can do it. Well, okay, if you just read that every day, is that really going to do anything for
Sure.
you? Not really. So con number one, we've got that currency risk. Changes in exchange rates can significantly affect the value of your investment. A decline in the value of foreign currency can lead to losses, even if the underlying stock is performing well. Again, sometimes, like, I was actually looking here recently because I'm thinking about going over to Europe, and I was like, oh, how much is $1 for a euro? And then, like, when I looked, don't quote me, but, like, this was a few weeks ago when I looked, it was like $1 equals 0.82 euro.
Yeah.
I was like, hey, okay, I'm going to get a little bit more. It's not really that much, but, basically to me in my brain, it's 1-to-1. It's not, but we're close enough. Con number two, we've got those geopolitical risks plus the policy risk. Lots of risk, the game. Involving in foreign markets, being involved and investing in foreign market exposes you to geopolitical risks, including political unrest, economic collapse, and changes in government policy that can adversely affect your investment.
Mhm.
So again, say a president of something of a different country decides to be like, I don't want to do this anymore, and you had all your money in that country invested in that, that's probably not very good, right? That's okay. So you got another country. You got your side countries.
Yeah, got to keep your roster full.
Exactly. You're married. I love that. Andrew,
Not
don't
for
listen.
long. I'm
Andrew,
just kidding.
Andrew, put your earmuffs on. No, just con number three is accounting / governance differences. So different countries have varying regulations and financial disclosures standards, so which can make it very, very challenging. And we talked about this in a different episode as well. You might not be able to obtain the information that you need. You can't really do your full due diligence on an investment because they don't really care about that in foreign countries. They're like, yeah, it's this. And you're like, but can I have more?
Mhm.
And they don't really always give that to you. So you
Yeah.
have to be, that's hard, or also different language.
Yes, there's some barriers.
Lots of stuff. And sometimes, we talked about in our previous episodes, today might not mean today in foreign countries.
Mhm.
So we're just, Americans are very impatient. So last con is that we have that liquidity issues. Some international stocks may trade in smaller markets, leading to lower liquidity. Again, you can only this many people can buy your investment. It's less people to buy. Can't really do it in your pajamas on the couch like I like. So this can be difficult to buy or sell shares without impacting the price significantly.
Yeah.
And that is why diversification within international investing across regions, sectors, and development levels is absolutely, absolutely crucial.
Yep, exactly. Okay, so let's get into maybe some real life stories of why this category matters.
Okay.
First up on the list, we're going to go to Japan.
I like it.
Japan has had long eras of being counted out, and then boom, renewed investor interest when reforms, earnings, and currency dynamics line up. Japan's economy is a fine-tuned engine.
Mhm.
It stands as the third largest GDP globally, with established infrastructure, well-bred innovation, and deep-rooted corporate ethics. Those Japanese businessmen,
I love
party
it.
hard, work hard.
I love it.
Just
Work hard.
work hard, play hard. Exactly. Despite demographic headwinds and a graying society, Japan's resilience relies in high-end technological R&D, strong consumer loyalty to domestic brands, and sound fiscal policy with disciplined inflation control. And not to mention, there's definitely a bit of a love affair going on between the U.S. and Japan right now. Lots of things in Japanese culture are becoming more popular here. People have an interest.
I like it.
For foreign investors, Japan's economic terrain offers a rare combination of risk-managed growth and durable returns. It's not about fast money, but it is about smart money.
Yeah, and it's a good thing I'm a pretty patient person. Working in hospitality for many years has made me extremely patient because you can't just scream at your at guests when they could just sit there and say the same thing over and over and over again. But that's neither here nor there, right? So next on our little tour is Europe. Europe often has heavier weight in banks, industrial, luxury, as we well know. I like a good luxury product from Europe. Energy, and sometimes being able to mix all of those little bad boys together really shines, especially when the U.S. mega cap tech isn't like the only thing you want in your portfolio. It's like not the one thing you want to marry. So you want to get a little bit of everything. Plus, different markets respond differently to what I lovingly like to call AI everything.
Sure.
Nowadays. So we've got these AI everything cycles. So some commentaries have suggested investors are actually rotating away from crowded U.S. positioning and looking overseas amid this bubble worries. We've talked about how we've been hearing a lot of things about this AI bubble. So where can we put our money, right? So last up on this emerging market, or last up is those emerging markets. So basically everywhere else that has in the world. Take India, for example. Corporate earning cycles, valuations, and policy can swing sentiments really fast. And in 2026 outlooks can hinge on both fundamentals and narrative momentum. Speaking of 2026 outlooks, let's peek into what is forecasted for this upcoming year for our investor friends.
Yeah, let's get into it. First, macro. The International Monetary Fund projected global growth around 3.3% for 2026. And its January 2026 update with advanced economics, slower and emerging/developing economies generally higher.
I like that.
Pretty cool.
Mhm.
Second, big picture equity expectations. Goldman Sachs research, the research content discussed a view that global equities could deliver around 11% over the next 12 months. That's
Mhm.
pretty high.
Mhm.
This includes dividends in US dollar terms
Mhm.
as early as of 2026.
Yeah, we're already seeing those.
Crazy. Third, longer horizon return expectations. Vanguard has been fairly direct about U.S. equity long-term prospects that they may be more subdued relative to recent history,
Mhm.
which is the one reason international diversification keeps getting emphasized, or one of the reasons
Yeah.
that people are kind of looking outside of the U.S.
Yeah, I like looking at these big guys who really know what they're talking about. We pretend that we know what we're talking about, but these guys, I like to read a lot of their outlooks and articles to really see where things are going because I want to make educated decisions, right?
Sure.
And educated choices, and that's why we do this research so that hopefully our listeners can hear some of this and maybe do a little extra due diligence, as we always tell you. But the last thing that is actually forecasted for 2026 is that investor positioning. So there's reporting that big fund managers have been upbeat on equities, but also wary about overinvestment themes and doing those concentrated risk, pushing some of that interest towards opportunities outside the U.S. Again, we don't need to all be in one little, just stay within the U.S. There's some great stuff outside. So in 2026 base case, you'll see in many outlook rhymes like growth is steady but uneven globally. Earnings matter more, not just valuations. Not the valuation expansion. Diversification matters because narrative concentration can flip fast. Translation, all those things. International equities may have supportive backdrop in 2026 if earnings broaden and that currency/headlines risks don't, full on body slam sentiment. Okay. So also please remember that these forecasts are not guaranteed. That dirty G word that we always remind you that is not there. Again, we are not financial experts. Okay.
Yep.
However, here's a practical take. You can get exposure through broad funds that cover developing and emerging markets, or even split them up a little bit.
So the key here is to pick a strategy and stick with it through the years, even when it might feel wrong or scary or risky. I'm not saying do something blatantly dumb,
Right.
but this is the deal with investing. There's always going to be some waves that feel a little nerve-wracking, but diversification can work like a seatbelt. It's most appreciated during the crash. If you have everything kind of spread out, and you know that, okay, there's a fire over here, but I got some other things that'll keep me safe, or safer, then that can be nice. And while we don't want our listeners confusing international with automatically safer, right? That's not what that means.
No.
It's a different risk and not no risk, and there is always risk.
Always risk. They made a game. Again, we mentioned that all. They literally made a game out of it. So the global economy doesn't revolve around one stock exchange. We need to remember that. Innovation is happening everywhere. Consumers are spending everywhere. Policy experiments, some good, some bad, are happening everywhere. Cycles rotate, and that's the part that people tend to forget about. The country that's crushing it in this decade might cool off next decade.
Yeah.
So meanwhile, the markets you ignored might quietly compound like it's training for a marathon. You never know what to be on the lookout for, right?
Yeah, that's right. Diversification isn't about predicting the next winner. It's about admitting what you don't know and then positioning yourself correctly from there and maybe learning a little bit more. And ironically, when you admit what you don't know, that is somehow the most confident move that you can make as an investor. Don't act blindly. Be, honest with yourself and be able to actually fill in the gaps of the things that you don't know with research. And in 2026, we're in a world of growth that's uneven. AI enthusiasm is global, currencies are flexing, and geopolitical headlines are basically pounding double
Like,
espressos.
give it to me.
Yes, won't go to bed.
No.
So spreading exposure across borders isn't just sophisticated; it can be really practical.
It really can. So again, thanks for tuning in to today's episode. We hope that this got you thinking outside the U.S., or at least made you maybe think, gosh, where'd I put my passport?
Or I need a vacation.
Yeah, that too.
Yeah.
That maybe requires a passport. Might need to get on that one, right? Don't forget to like and subscribe, and feel free to tune into our YouTube channel.
Yep.
You can see us IRL if you so dare to.
Yeah.
But always, until next time, we'll see you then.
Thanks for joining us. Stay tuned for more insight on our next episode.
And don't forget to subscribe to continue the Alternative Investments chat. See you next time.
Content provided in this podcast is for informational purposes only and should not be construed as professional, financial, or investment advice. This podcast should not be construed as an offer to sell or a solicitation of any offer to buy any securities. We strongly recommend that you seek advice from a qualified professional before making any financial decisions.